Our next guest is actually in the camp that the Fed should pause next week. Let's bring in Mark Zandi. He's the chief economist at Moody's Analytics. Mark, great to have you with us. I'm guessing you think pause now because of what has transpired in the banking sector. So is this an explicit choice of financial stability over price stability for now?
Yeah, I think they'll pause. I think they should pause. Will they? That's more of a debate. But, I think policy making 101 says if there's a lot of uncertainty and there's a boatload of uncertainty about all of this, then you err on the side of being overly accommodative. So that means no rate hike at the next meeting. I think then they can stop, take a look around, make sure the system is on very solid footing, credit's flowing, take a look at the economic data over the next few weeks, the inflation numbers, the jobs numbers, and make a decision at the May meeting and resume increasing interest rates if they need to. But, at this point, given all the uncertainty and given what they did, they pretty aggressive actions when you set up a new credit facility to provide liquidity to the banks. And, you're part of the action to guarantee all the bank deposits. Given that, it just seems to me that you'd want to pause here and just take a look around.
Hey, Mark, it's Courtney here. As I noted in your notes, you actually made a point that we should watch for oil right now, right? And that you're seeing because of the supply and demand, and it has been lower, you expect that to increase. I'm just curious if you can expand upon that a little bit, because I think the supply-demand constraint, we've actually argued quite a while the last several months, but energy prices have remained low. And I'm curious what your take on that would be.
Yeah, Courtney, I've been a little bit surprised at how low oil has remained. And that's fantastic. That's really key to the inflation outlook. The direct impact on inflation, the indirect impact through food and transportation costs. But most importantly, the impact oil has and gasoline prices have on inflation expectations and wages. And so keeping oil down in the 70s, low 80s, that's really been pretty good and surprising, in large part because demand has picked up. China has come back and demand has picked up. So and of course, you've got the Russian sanctions that increasingly are biting. So I have been surprised. But, I do think as we move through the year into next, the supply demand balance will start shifting towards higher prices. So I wouldn't be surprised that at year end we're closer to $90 a barrel than 75. But there's some calls for $100. I doubt that. I don't think we're headed in that direction, but certainly higher than where we are today.
Hey, Mark, it's Tim. This is not scientific and this is qualitative, but your view is very important to the audience. What's going on with banks? What does this mean for the economy? What is the element of this that is a slowing in lending at a time when we'd started to see a couple of years of really growth in C&I loans and dynamics in the banking sector that we hadn't seen in a long time? I think it's very negative, but your view is more important here.
Well, it's negative. All else being equal, the banks provide, it's key to the credit flows to the households and to businesses, and credit growth has been good. There's been some tightening in underwriting. We've seen, from this Fed senior loan officer survey, for example, but, the actual growth in credit has been pretty consistent with the growth in the economy. That's, exactly what you want. I suspect here, given what's happened, we'll probably see some further tightening in underwriting, some weakening in credit growth, and that will be a drag on economic growth. Another reason why the Fed may want to, pause, take a look around and see, how big a tightening and underwriting there will be and how significant the impact will be on credit flows. But having said that, Tim, there's, the other financial conditions have eased up, right? Long-term rates are down. Mortgage rates, which were 30-year fixed, were over 7. They're now back down. Last I looked, closer to 6.5. So there's kind of cross currents here when you add up all the impacts on financial conditions, and the net of all that is probably, at least at this point, a wash. But again, given the uncertainties, if I were a policymaker on the Fed, I say, hey, let's just pause here and take a look around.
You said that what's going on in banks is not a systemic failure at all. It's not a systemic risk. Is it because of the intervention that had gone on over the weekend that does not make it a systemic risk, or would it not have been a systemic risk anyway? And we did this intervention for whatever motive, protect depositors, political, whatever you want to call it.
No, great question. Obviously with the backstop, the system is money good. The message here is that the government is going to do whatever it takes to make sure the system remains on solid ground. So we're good. I would have said, before all this, that, one of the strengths of the economy, one of the reasons why I've been generally optimistic that we can avoid an outright economic downturn is the strength of the banking system. Just objectively, take a look. The Tier 1 capital ratio is very high. Obviously, a lot of that's related to the reforms after the financial crisis, Dodd-Frank. Liquidity, very good. Credit quality, it's starting to weaken, but basically just normalizing for most loan categories. So profitability is strong. Look at return on assets or return on equity. I mean, it feels like the system was a reason for optimism about the strength of the economy. And I still believe that to be the case. I think we've got a few idiosyncratic institutions that just went sideways here and got caught, with the rise in interest rates. And I don't think it's, broadly symptomatic of what's going on in the banking system. But again, having said all of that, look, I could be wrong. There's a lot of uncertainty. Let's just take a breath, take a step back and assess things. Don't push, harder on interest rates until we're absolutely sure I'm right about the system.
Mark, great to see you. Thank you.
Sure, anytime.
Mark Zandi. So it's a real push-pull. I mean, in terms of tightening of lending standards, not getting that money out into the economy, which is good for the Fed's fight inflation. But at the same time, again, mortgage rates, interest rates are down. I mean, where do you come out on it?
Well, I mean, I think they've been doing the right thing all along. I mean, I still think they should stay the course. They've been extraordinarily vocal in their want to kill inflation.
Did you just say I think the Fed has been doing the right thing all along?
Yeah. Well, no, not all along.
Since
they started raising. I've been pretty clear on that.
Yes.
That they finally doing the right thing. And I think they've been pretty good at explaining what they're trying to do. Now, if they backpedal and are spooked by what's going on, that's an entirely different conversation. Because last I looked, 6% inflation is nowhere near their target rate of 2%.